Hey everyone, give me 1 second. I'm turning on the pointer. There we go. So let's take a look at the daily chart. There we go. Looks like the microphone is working just fine. So on the daily chart, it's pretty interesting. One, you can see we're getting a lot of overlap, and the bears, they're trying hard to get a downside breakout. So the bears, let's do this, give a full picture. The bears, they obviously want a plunge, a break below August the 16th. However, more likely, we're probably going to continue in this tight trading range. You can see all the overlapping bars that we've had for the past several days. We have a bear bar, then a bull bar, outside down, inside bar, bull bar, bear bar, outside down bar. This is a trading range and it's a tight bear channel. The bears, they're trying to get a downside breakout. So, in other words, the bears are hopeful they can get this, but realistically, probably not going to happen, but it could happen. On the weekly chart, tomorrow's Friday, so this is the last, tomorrow will be the last day of the month, and we have a big bear bar and a follow through bar. For the bears, there's a few things. One, everybody knows the market is too far from the moving average. Here's the moving average, this blue line, and the market is just too far up. And that's in part why we're pulling back here. Now, for the bears, they have a good bar on last week, and they're hoping that next week, which is, in other words, they're hoping this week closes on its low. So tomorrow will be interesting. Will the Bears be able to get a bear bar? Can the Bears close this week below the low of last week? Can the Bulls get a rally? As big as this bar is, it's about a 70-point bar. So it's pretty big, but it's not huge. And if we could get a rally, the open of the week is 45.18. So if we could rally pretty much 30 points, we'd be back to the open of the week. So it is not at all impossible that the market gets back to the open. I think it'll be interesting to see. Let's take a look at the 60-minute chart on the Globex. So let's think about this for a minute. Here's the 60-minute chart of the Globex market. And here, we're clearly in a bear channel. Big bear bars, deep pullbacks, sell off, deep pullback, sell off, deep pullback, bigger rally, and then a deep pullback. What do you think is more likely? Do you think that the market is going to break strongly below, or do you think we're going to go sideways? I think the odds are we're going to go sideways. And the open of the week is basically right here. So all the market has to do is pretty much get to this red line, and we will be very close to the open of the week. If we got two legs up from this bull bar, even a measured move up of the bull bar, that puts you above the open of the week. So I would not be surprised at all if we go sideways and rally up to here. This is the best looking sell off in this channel that began on August the 4th. So I think overnight it'll be interesting. I think more likely we open up here than getting way down here. In other words, I think it's lower probability that we get a bear breakout below a bear channel. And obviously the bears, they are hoping for some kind of double top and a break below the neckline. Oh, 400, here's a 480-minute chart, 8-hour chart, basically the daily chart. But you can see there's a lot of buying pressure, and that increases the odds that we start to go sideways. Here's yesterday's high. Here's yesterday's low. So first bar of the day, it is a bull bar, and it's a reasonable stop entry buy. Big enough bar. Are we always in long? Well, we're gapping up, and we have a bull bar, so we probably are always in long, getting near the open of the week and the high of yesterday. So it's okay to wait for follow through, but some bulls will buy above it. And two, now we have consecutive bull bars, probably buy the close and buyers below two for at least a small second leg up. Three, a doji, but probably buyers below three scaling in lower. And four, it never triggered. And four is a bull bar. For the bulls, it's two legs up. And the bears, they hope that it's a trap. They see a rally on bar one and two. In other words, they see a failed breakout of yesterday's high on two and three. And they see four as a second attempt. So they're hopeful that five closes on its low. But it's a micro channel since one, in three out of the past four bull bars. Three out of the past bars are bull bars closing above their midpoints, so the bulls are stronger. In general, 50% chance that bar one, 50% chance that the initial rally on the open fails. Follow through on five, still by the close, probably going higher. And then we have another big bull bar on six. So what do you notice about this pattern? We rallied, we have a big bar on one, overlap on two and three. We have a big bar on four, overlap on five. And now we have a big bar on six. That's a warning that this is some sort of climactic move. So in other words, you can argue it's a parabolic wedge with 2, 4, and 6. 7, we have a doji. Weak follow through for the bulls. You will have bulls buying below 7 since it's a micro channel from the bar one low, but it's climactic and parabolic, and that increases the chances that this is a buy climax and an early high of the day. Let me see if I can pull this up really quick. I'm going to show one or two examples of the encyclopedia. While this is loading, I'd be interested to hear for people to comment on what was easy about today and what was difficult about today. Ideally, what was difficult about today. So today we gapped up, and what I normally do, I go to the index and I scroll down to gap ups. So here is a gap up, and let's see our choices. So if I don't know what I'm looking for, I just start scrolling through. So gap up, sell climax. Okay. I bet there's a gap up and buy climax. So there's bull traps, gap up. But one of the things that's helpful with the encyclopedia is to just start looking at examples. So I'm sure there's some sort of. So part 7, gap up, buy climax. So if I go to part 7, right here, I can type in. You can't see my screen. But anyways, what I often do, here's the encyclopedia. I scroll down, I click on the file, and then I start looking for examples in here of what I'm looking for. And what I'm looking for right here is if I go to part 7, gap up, buy climax, this is what I'm looking for. It's common on the open to get some kind of parabolic wedge on the open. So 1, 2, 3. Here's a parabolic wedge, or you can argue buy climax and then a parabolic wedge. 2 big bull bars, parabolic wedge there. So you can see, pretty common. Parabolic wedge, pullback, another buy climax. So today might be one of those days. And whenever you get a rally like this that's unsustainable, it increases the risk that the market is going to start to go sideways soon. The market went up too far too fast, and you'll have a lot of traders taking profits. 7, like I said, small doji, probably buyers below. 8, high one buy, probably sellers above. 9 is a bear bar. First bear bar closing below. First bear bar going below any bar other than the doji on 8. So the selling pressure is increasing. But after all the bull bars up to bar 7, probably buyers below. 10 is a second bear bar. Now we have 2 consecutive bear bars and a 4-bar micro channel, probably sellers above 10 scaling in higher. You can see some bulls, they bought the 7 close, disappointed on 8 and 9, getting out break even on 10. 11 broke below 9 and reversed up. What about buying above 11, betting that the market will get a second leg up from the rally up to 7? Some traders will, but my problem with buying above 11 is it's a micro channel, and that increases the risk that there's more sellers above 11 than buyers. 12, there were so many traders trying to sell the close of 11, it couldn't trigger, and we broke below 11, but probably buyers below 11 and buyers below the 6 low, the final big bull trend bar. A lot of traders, rather than buying above, a lot of traders, when they're looking to buy below a bar, rather than buying below the first bull bar, they'll look to buy below a bigger bull trend bar because that's a sign of urgency and strength. And if you're buying below something that's strong, it increases the odds that there's buyers below it. And you can see that's what happened on 12. 11 tested it and 12 turned up. So what about buying the close of 12? Some traders will, but it's a micro channel since 7, and that increases the risk of sellers above 12 and at least a small second leg down. We triggered the buy above 12 on 13, but we could not close above 13. We could not close above 12, and that's a sign of weakness. Probably buyers below 13, but we have a wedge 1, 2, 3. And because of that, and the moving average is a little bit lower, we could get a downside breakout and a test of the moving average pretty quick. 14, a little bit of a surprise bar, closing below 12 and closing far below 13. Probably buyers below, but if we get a follow through bar, we could easily get a sell off. This is a possible bear breakout below a bull flag, spike or breakout, pullback. So this should be a bull flag, and we get an upside breakout, and it looks like we might be getting a downside breakout. And the bulls, they want the next bar to get a reversal up. And 15, now we have consecutive bear bars. Are we always in short? I think so. I think 14 and 15 is strong enough for at least a small second leg down, but we could easily test back to the 12 low or the 14 close before the bears get a second leg down. 16, now we have 3 consecutive bear bars. Probably sell the close, but you're getting near the low of the trading range. There were bears who sold on the open or anywhere in here. They were trapped. And because of that, bulls, they were obviously buying aggressively. That makes the midpoint of this bar a support level. With this many bars down, you'll have some traders buying and scaling into longs looking for a scalp. But with the sell-off down from 14, 15, and 16, I suspect it's sell the close and sellers above for at least a small second leg down. 17, we have a bull bar. For the bears, for the bulls, they see a second leg trap. Leg 1 on 12, sell off on 16, and they see the buy above 17 as the trap. Probably sellers above 17, but we may get a deep pullback. You'll have some bulls who bought above 12 and more above this bull bar, and that makes the break-even price the 14 low. Remember what I said a few minutes ago? 14 is a big bear bar, but it needs follow through. You'll have some bulls buy the 14 low, and they got trapped on this sell-off. Therefore, they bought and they scaled in. They're probably going to try and get out break even around the 14 low. 18, we have a low 1 short. Probably buyers below, but the sell-off down to 16 is strong enough for a second leg down. So if you're buying below 18, it's more dangerous than what it appears. And then we have a surprise breakout on 19. 19, it trapped the low 1 bulls buying below 18, and it trapped out bears who were looking for a pullback after 17 and 18. Is it sell to close on 19? It might be, but some traders I suspect will be interested in looking to sell a pullback. However, because the bulls who bought the 18 low and more lower are trapped, traders will sell to close and sell a pullback. And then on 21 or 20, we have a doji, probably sellers above, scaling in lower and scaling in higher, but probably buyers below, scaling in lower. 21, we broke above 20 and reversed down, probably buyers below 21, but the breakout on 20 or 19 is strong enough for a second leg down. So leg one, pullback, we'll probably get a leg two, and we might get a measured move of this breakout. We have a breakout point, 12 low, 18 high. We've already reached that. Next target, there's a few targets. One, we came really close to the open of the day at 9 even, and the low of this bar is 9.5. So some traders will wonder if that's an adequate test of the open of the day. And if it's not, that means we'll probably have to fall below it, and we may have to fall below the one low. So low probability of traders. That makes buying here more difficult. Plus, bulls are having a lot of trouble making money. Whenever traders start to buy below bars and make money, you had bulls buying below 16, scaling in lower on 20. They made money. Whenever that starts to happen, the market usually converts into a trading range. I like to think about that as drawing the green box I often draw. And if you look, there was the trading range. We sold off, we got a second leg, and then we got a third leg, and then we got the strong rally right here. But what do you notice? So this met the minimum of a trading range. But look at the 18 low. The low is 22.25. The high of this bar is 21.5. So the market could not get back to the 18 low. There were so many sellers up here that everybody started selling. If you think about it, 24 and 25 probably should have had a second leg up, and instead it trapped bulls. It trapped bulls in the buying high. So just like the bulls that bought a pullback from 18 after 17 and the rally on 18, the bulls that bought a pullback on 19, they got trapped. And the same thing happened here. So that makes it a little more challenging, but I suspect there's buyers below 21 scaling in lower. Now we have a parabolic wedge, 1, 2, 3. I would get out of the shorts above anywhere. The bulls, they'll see this as an opportunity to buy a failed breakout below the one low, and they'll probably take it, betting the gap closes at the 21 low. 24, a little bit of a surprise, probably going to go at least a little bit higher, tight bear channel down from this high up here. So the upside's probably limited. In 25, now we have consecutive strong bull bars. Consecutive bull bars at the moving average, probably going to go higher. However, it'd be better for the bulls if they could close above the moving average. This channel down is tight enough that it's a breakout on a higher time frame, which means this may just be a pullback on 24 and 25. Also, here's the 12 close, which means here's the second hour open on the hourly chart. Let's just pull it up. So this is the close of the first hour. Right, let me just do it like this. Here's the close of the first hour. There's the first hour, and you can see the second hour sold off. And then in the final 2 minutes of the hour, it painted a big tail. So when you look at this bar, are you all that excited to buy the close? Of course not. Not many traders want to buy. I'll make it, it's probably easier to see like this. Not many traders are all that eager to buy the close of this bar. It might rally a little bit on the open, but this channel down is tight enough that the upside's probably limited. So there might be more sellers up here than buyers, but I suspect 24 and 25 is strong enough for at least a small second leg up. Doji on 26, probably buyers below, but testing the 18 low. So obviously that's the risk for the bulls. And then 27, surprise bar, trapping bulls that bought below 25, bought below 26. 28, consecutive bear bars. So it's a bear breakout below a wedge. 1, 2, 3. which means we may get a measured move down somewhere down here. Consecutive bear bars 27, 28. Are we always in short? I think so. But if we get a strong bull bar for reversal, traders may look to exit. And then we have 3 consecutive bear bars, still sell to close, probably going lower. But we had a lot of buying pressure in here and a lot of buying pressure here. And it's possible this is a second leg trap. Leg 1, pullback, leg 2. We have a tail on 27, which means at the 27 low, which means bulls bought into the close. We have a tail on 28, which means bulls bought into the close. And now we have a tail below 29, which means more buying into the close. So the tails are getting bigger. And that's a warning that this is parabolic. And that's what led to 30. 30 is a bull reversal bar. What about buying above 30? I think it's a tough call. 3 consecutive bear bars, probably limited upside, but it's certainly okay to exit shorts above 30. For the bears, the risk is pretty big, and this is not how bear trends normally behave. This is how trading ranges behave. Bear trends do not get strong consecutive bull bars, and they especially don't get strong rallies like this. So I think it's fairly low probability. This is pretty big. We might get a measured move down, but I don't know. If we do, it's probably going to be a trading range. This is a pretty common situation where you have a high and you sell off back to the open, like 23, and then you try and get a measured move down of the range. And if you do that, which it pretty much happened right here, actually it happened to the tick. Okay, so this worked out pretty well. Here is, let me just snap it. So the low is 73.25 and this low is 73.5. So the market came within 1 tick of the measured move from the high of the day to the open. Now, why is that important? That's important because it puts the open of the day at the midpoint of the bar. And if the open of the day is at the midpoint, if you're a bull and you buy down here, you have to think about it from the standpoint of if this is going to be a trading range day, we might get really close to the open of the day. So you'll have some bulls think about it like this. If they buy anywhere down here at about a measured move of the opening range from basically bar 1 to or the bar 7 high to the 23 low, if they buy a measured move down, the risk can be probably less than what the reward is. So the reality is the market's probably not going to go all the way down here before it gets to the open. And even then, if the bears start to get big bear bars, they'll exit for a smaller loss. So that makes the math actually tend to favor the upside. And that's in part why we tried to rally for a couple of legs, but we ultimately couldn't get there. And then we closed probably around the middle. But let me go back to this area right here. So I mentioned the bull bar, probably sellers above, but the risk is big. You had some bears sell the close of 30 of 29, disappointed on 30, and they're getting out break even on 31. 30 is strong enough for a second leg, and you can see they were disappointed after 31. So you had some bulls buying the close, disappointed 31, getting out break even, and then the market formed a bear bar, closing on its low. For the bears, it's a breakout pullback short, and some traders will argue it's a low 1. Some traders will argue it's a low 2. We went up on 30, and then we went down on 31, and then we went up on 32, and we went down on 32. So that is a double top or a 2-legged pullback, and it's a test of the 28 close. What about buyers or sellers below 32? It's tough to buy below it for the reasons I just mentioned. And even if you call it a low 1, it's a low 1 after strong breakout. So it's kind of like 18. It's a low 1 after 3 big bear bars. And that increases the risk that there will be traders holding for a swing. Even if you get a pullback first below the low 1, in other words, even if there's buyers below 32 scaling in lower, they'll be pretty quick to exit. So there might be bulls below, but if there are, they'll probably look to scalp out. 33, a bear bar, probably going to go at least a little bit lower, but you can see hesitation by the bears in terms of selling. For the bulls, if they bought below 32, I suspect that you'll have more bears. You'll have more bulls who bought below 32 disappointed. They bought the 32 low and they wanted the market to go up quickly for a scalp. And instead, the market formed a bear bar. So we're probably going to start to go sideways. 34, another bear bar. Now we have 3 consecutive bear bars. And we have 4 consecutive bear bars with 3 highs below the high of the prior bar. So it's a 3-bar micro channel. And we have 4 consecutive closes at or below the prior close. So it's a sign of trending behavior. And we have lows that are at or below the highs, the lows of the next bar. So bear bar, here's the low, equal low, new low, new low. So the market's starting to trend again. Now we have a fourth. We have 5 bars down and another bar, so a new low and a lower high. So that's a sign of trending strength. And then you can see 36, we broke to the downside. We tried to get a measured move of, we probably got a measured move of this bar here and here. We didn't quite get that. So that's a target. We got a measured move of that. Let me just check one thing. There's one target, this high to this low, pull back down to there. But either way, third leg down for the Bears. For the Bulls, they see a wedge, 1, 29, and 36, or 23, 30, 29, and 36. Reasonable to exit shorts above this bar. When you get a reversal up like this bar, 36, usually the market can reverse pretty quick. And we had a big bull bar here, rally here, big bull bar on 30. And whenever you get a pullback, especially in what is overall a trading range day, this bar right here is usually the formation, is the start of a trading range. So it can happen pretty regularly where you have a low, you rally, and then you get a second or third leg down. But it just about goes a measured move of this range, this tight trading range right here. However, once it gets there, the market's already in a trading range. So the market starts to sell off and then it just starts to go sideways. Bull bar 37, probably buyers below 37, scaling in lower. And then we have surprise bar on 38. So you have bulls, bears giving up, aggressive bulls buying, but a very tight channel ever since the high of 28 or 26. For the bulls, they see it as a strong enough breakout for a second leg. The bears will see it as a buy vacuum, test of the open of the day, test of the 23 low. 39 is a doji. 39 is an important bar. Let me see if I can do it like this. So everybody knows that a trend, here's what happened on 38 on this bar. So 38 went up. And in a trend, if you think about a line chart, why do parabolic moves happen? Because they look like this. They rally, and then bar 3 pulls back, bar 4 rallies, but then the high of 4 and the low of 5 pulls back, then bar 6 rallies, even steeper, and then it starts to pull back, and then it starts to drift down. Here, notice right here on 38, 38 went up, and let's say this is the low of 38 right there. Here's the high of 38. Look at 39. 39 was basically a 50% pullback. So what is this part right here? 39 is a doji. It sold off and rallied. And because of that, the low of 39 is a downside breakout that failed, and it went up like this. That will increase the odds that there's sellers on any pullback at a new high. So let me get rid of that. And then you see you have a bull bar on 40. So the bulls, they can argue it's 2 legs up. Some traders will argue it's a wedge. We went down on 36, up on 36, down on 37, up on 38, down on 39, up on 40. And that's in part why 41 looks the way it does. 41 is a surprise, and you can see it was a test of the 23 low. You had bulls who bought the low of 23, scaling in lower. They were so disappointed by the sell-off below 23 and bars 28, 29 that they bought back shorts. Excuse me, they sold out of longs right at the low of the bar, at the low of 23, and we couldn't even get above it. So the low of 23 was 4506.5. The high was 4506.25. So it's an open gap. It's a negative gap, but it's also an open gap. The tails did not overlap. 42 consecutive bear bars, probably more exhaustion and going to start to go sideways soon. So I see 41 as strong as 41 and 42 are. I see it more as a leg in what's already a trading range. In other words, this green box is a trading range right here. So to me, even though we're breaking below it, I suspect we're going to go back into this range. We got a second leg down, 43 bull bar, and then 44 another bull bar, and then we went down on 45 and we went up on 45, and then 46 is a bear bar. So that's a two-legged pullback. We rallied, we sold off on 45, rallied on 45, and then we sold off again. So it's a leg one, pullback, leg two, and a test of the breakout point, the 41 low. You can see it right here. There's the breakout point, low of 41 in these highs. 46, 47, second leg down from 41 and 42. And then 48 is a low one short, but probably buyers below 48. And then you can see what happened on 50 and 51. 51 broke below the 78 low and yesterday's low. And it also came really close to reaching this measured move target. Let me see if this is actually drawn in accurately, because I don't think it is. Let me just redraw it. There it is. So we have this measured move target just below, may go a little bit lower, but 51 is a warning that something is not quite right for the bears. Big bull bar, 52, and you can see any of the bulls that bought the 46 low right here, 89.25. The high of this bar is 89.25. It's still an open gap, but any of the bulls who bought below were able to make money. And that's a warning the market's is evolving into a trading range. 53, bear bar closing on its low, but low one short after a bear breakout below a bear channel right here. So probably buyers in this area. And then 54, surprise bar down. It's a measured move from 41 and 42. So that's good for the bears. But we have a sell climax here, another one here. This is probably going to start to go sideways and may reverse up pretty sharply. 55, bull bar, second entry buy for the bulls. It's a second failed breakout of yesterday's low. Reasonable swing buy. I would certainly get out of shorts above the bar. 56, 57, strong enough for a second leg up, but tight bear channel down, so we may not go straight up. 58 is a reminder that something is wrong with the bull case. If this is going to be a strong rally, the bulls should not have allowed that strong of a bear bar, and because of that, there's going to be sellers somewhere above. The sellers may not come in at the high, but look at this. They came in about halfway. So the point I'm making is if you sold here and you didn't get out above 62, you will have bears scale in. And you can see they ultimately made money. So whenever you get a strong rally and then you get a big bear bar, you have to think about risk reward. Most traders won't buy this low and put a stop down here and a target up here. Therefore, they'll be pretty quick to scalp out. So 58 is a bear bar. It's a test of the 45 high, the start of the bear channel. The bears are hopeful it's a double top with 45 and they get a measured move down, more likely sideways. The bulls that bought the 57 close scaled in lower. They got out break even. But we have a high one buy on 59 and then 60, second entry short. Some traders, they sold below 58. Disappointed 59, they got out break even on 60. 61, you can see The bulls that bought the 57 close. The bulls that bought the 57 close disappointed with 61. They bought the close of 57, disappointed in here with 58 and 60. They got out break even on the 61 close. 62 bull bar reversal up. You can argue it's a second entry buy, but we failed to trigger the buy above 59, and that lowers the probability of buying above 62. 63, we triggered the buy, and it's an outside up bar. Buyers, there was buyers below 62. What about buying above 62? I suspect we'll probably trigger the buy above 62 and 63 and go a little bit higher. The bulls that bought the 57 close will probably be able to get at least a small second leg up. In other words, we'll probably get above the 58 high. 63, a little bit of a surprise, but a tail on top, a warning that something is not quite right for this bull rally. And then we have another bull bar on 65. 65 is it by the close? It's probably by the close, but you have an obvious target just above the low of this bar where traders got trapped. It was reasonable for bulls to buy, hoping for a second leg up and maybe a test to the open of the day. And they got trapped on this big bear bar. So you know this line is resistance. Plus, we have a tail on 62 and then a rally on 63. So it's in essence a two-legged pullback. We rallied on 62, sold off. We rallied on 63. If 64 is a bear bar, that would be a low two short. It would be a large low two, low one, pullback, low two, nested in a smaller low two. 66, and consecutive bull bars, but right at the move at this red line. And then 67, surprise, bear breakout. The bears that sold above 63 and more higher made money. 67 is a strong enough bar. It'll probably get a small second leg down. So the bulls that bought the close of 66 or 65, I suspect they'll be pretty quick to look to get out around break even. The bulls that bought the 66 low, same thing. Probably sellers above 67, 68, probably sellers above. And then 69. Now we have three consecutive bull bars, but I suspect 67 is strong enough that we'll get a small second leg. Probably buyers below 70, but the buyers may not come in until the 67 low. $71, a little bit of a surprise. Is it sell the close? It may not be sell the close, but that's certainly not what you want to see if you bought the 70 low. And then 72, now we have consecutive bear bars. For the bulls, hoping for a second leg up after from the rally from the 63 low to the 66 high, this is a problem. Consecutive bear bars, obvious magnet below the 54 close, and the high of 55. So this is an area where I think bulls are trapped and bears will start selling closes and selling into shorts. 73, three consecutive bear bars, but we have a pretty big rally here in bars above the moving average. That means the odds are this will be a bear leg in a trading range, even though it looks strong on 72 and 73. 74, a doji. Whenever you get a doji in a sell to close market, which it was sell to close on 72 and 73, even 74 is sell to close, but it's at the red line, which is the 55 buy signal bar high, and that will create support. And whenever you get a doji in a sell to close market, usually you'll get one or two more bars in the sell to close market before you get a reversal up. So this means if we sell off below 74, there might be buyers below. We had this on the daily chart. There's the July 6th high right here, and we came really close to it and we bounced. Second leg down 75, but you can see traders bought the close, and then we went sideways into the close. For always in, I thought it was always in long on the close of one or two. And where do traders get out? I think they can get out below any bar, or they can get out below 10. And certainly if they're still, or they can get out above 12. And if they're still long, they have to exit on the sell off on 14. Always in short on the close of 15. And where do bulls get out? Where do bears get out? If they get out above this bar, 17, they probably sell again below 18. And if they get out below 24, they probably sell again on the way down on 27 or the 27 close. And if they get out above 30, maybe they sell below one of these bars. But I think it's okay, even if you got out above 30, to probably stay flat in here. And you could argue that bears bears certainly get out above 36 or 37. And bulls, do they buy? Some might, but tight bear channel, so probably limited upside. With this being a parabolic wedge, 1, 2, 3, test of the double top, the 32 high. I think a lot of traders will get out a couple of points below 40. Bears, they can sell the 41 close for at least a small second leg down and a test of the 36 low. But you're in a trading range, and that increases the odds that the market's going to start going sideways fairly soon. And for the bears, do they get out above 43? I don't think they have to. And if they're still short here, they probably get out above any bull bar. And it doesn't trigger above 52. I would certainly get out of this bull bar. Aggressive bulls buy. They don't have to get out there. If they get out below 60, they buy again above a bull bar. They buy again above this bar. And if you bought above this bar, I'd use a wider stop because even it's a high one, and it's common for high ones to trigger, fail, and then reverse up. Plus, the context is good. You had consecutive sell climaxes all the way down in a strong rally, so expect a second leg. And bears, where do they get out? That's kind of a tough call because if you're long here and then you see this big bear bar, you know there's probably sellers above. But if I was trading just strict always in, maybe you get out below this bar right here on what bar is this? 71. And then it's always in short on 72 or 73. And then you probably get out as 75 goes above this bar. As this bull bar 76 goes above 75. For stop entries, I thought, that tough to sell on the way down. You had lots of strong bull bars. I thought the best stop entry was probably 55. At least the context made a lot of sense. And other than that, I thought it was okay to buy above 1, but 1, the risk is pretty big. How big is this bar? It's about a 15-point tall bar. So it's not small by any means. For limit orders, I thought probably buyers below any of the first 7 bars, but a little bit dangerous to be buying the 7 low. Probably sellers above 12 and sellers above 14. What about selling above 17? You can, but most traders don't want to sell above a bull bar. What about buyers below 18? Some might buy below 18, but it's rather dangerous after 14, 15, and 16. Probably buyers below 16 and 17 on 19. Buyers below 21 or 20 scaling in lower, they get out on 24. Probably buyers below 26, but at the moving average and close to a price level, the 18 low, where you had a lot of bulls get trapped on 19. So a little bit dangerous to buy anywhere around the 26 close or 26 low. 27, surprise, bear breakout, probably going to go lower. So you can sell or sell above, probably sellers above 31. And the reality is there's probably buyers below 33, 34, 35. And that's in part what happened on 36. And then as far as buying below 40, I would not possible wedge. Probably sellers above 43 for a second leg down. And then probably buyers below 50, 51, or even 52 or 53. But you need a wide stop. Probably buyers below 59, scaling in lower for a second leg up, but probably sellers above 59 as well. 59 is a high one. So you'll have some traders selling above it, but probably buyers below. outside up bar or bull bar, probably buyers below it. Sellers probably above this bar, so 68, 69 for a second leg down, and then probably buyers below 74. I think it's kind of dangerous to be selling the close of 74. If you think about 74, you're buying an area where traders got trapped. You're selling an area where traders got trapped. 54, big bar, probably going to fail. Bear breakout below bear channel. But those traders never had a chance to exit shorts, and you can see what happened. The market sold off and came really close to the low close on 54, and it tested the midpoint of this bar and reversed up. Let me take a look at a few questions. By the way, I'll be doing a Q&A after the trading room session. So that will be at 4 o'clock Central, so 5 o'clock Eastern time. So pretty much this time tomorrow, I'll start a Q&A session on the YouTube channel. So you can, and however everybody finds the links to these videos, they can do the same for the Q&A. And it'll be very similar to the one on Saturday. It just won't be as long. Okay, question. Was it okay to buy above 55 looking for the 45 low? So was it okay to buy above 55 here looking for a test of the 45 low here? I think that made a lot of sense. Consecutive sell climaxes, bear breakout below a channel, plus one of these rallies is going to work. And the best looking bear bar in the move, it's really common you often hear Al talk about strong bulls, strong bears, weak bulls, weak bears. The strong bears were selling here and up here, and they're taking profits along the way down. They see 41 and 42 as a gift. That'll probably go a little bit lower, but they see 54 as exhaustion. How much lower is this really going to go? And the strong bulls, they see this as a great opportunity to buy. They're buying yesterday's low. They're buying big bear bars. They're scaling in lower. They're not going to look at 54 and think, oh my gosh, I've got to get out. They're going to buy more. And you have the weak bulls. The weak bulls, they started buying anywhere in here, and they were hoping that the market would immediately reverse up. And when it kept trickling down, they started to panic. And a lot of those traders, they exit right here. They can't stand the loss. They can't stand the risk. And therefore, they bail out. And obviously, the weak bears do the opposite. They missed out on the strong sell-off. And they eventually start selling down here, only to sell late and the market reverse up. That's kind of a fun saying. But, realistically, you can make the argument that computers obviously drive the market. Institutions drive the market. So what's the real reason for 54? It is a vacuum test. And, there's a saying that, nobody knows when the market has gone too far, but when it has, it's obvious. In other words, what I mean by that is it can be difficult to look at this and think, yeah, that's the low. But eventually you start getting enough bull bars, and then you get a big bear breakout bar and then an immediate reversal. And what traders do is they take chances. Here they buy, it reverses up, but it gets too deep of a pullback. They scalp out. Surprise, they hold for a second leg, and they look at 51 and they think 51's exhaustion. However, they know at least 50 to 60% of the time, whenever you get an exhaustion bar like 51, you often get a small second leg, which is what happened on 54. And that's why 55 went up. Okay, question. If buying 62 for a swing to the 40 low, is the stop below okay? So if you buy above 62 for a swing back to the 40 low here, that's reasonable. Is that stop okay? It's hard to re-enter after getting stopped out on 63. Yeah, there's a few things with that. One, I think there's a few things. One, 60.59 did not trigger. And because of that, it's a micro channel down to the 62, the bull bar on 62. And that increases the odds that there's sellers above 62, more so than if 659 would have triggered the high one and sold off. And then you have to think about where you are. Trading range day, the market's always trying to do something to trap traders out of a good trade. And this, I know the concern. You're buying above a high two, you're worried it's the top of a trading range. You do not want to get a bear breakout above a bull flag, below a bull flag. So kind of like here, tight trading range. And then you get a bear breakout below a bull flag. 1 second. So for me, whenever I see a strong rally like 54, 55, 56, I'm willing to put my stop at least a little bit further than the 62 low. If it falls several points below 62, that's a problem, but it could easily fall, you know, in other words, it could easily fall maybe down here and then reverse up. So I think it's okay, put a stop. In general, when in doubt, put a stop maybe 2 points below the signal bar low. It seems hard to re-enter after getting stopped out. Yeah, that's common for trading ranges. But you can see bulls that chase the market up, they got trapped on 67, and that's pretty common. And I think that was all due to this right here. This is too strong. This is too much selling after a strong rally. Question: was today an example of a day where you would buy before the first 6 bars had formed because of all the bull bars? Yeah, I often talk about in the blogs how most traders should avoid the first 6 to 12 bars. And the reason is there's a very high probability that you're going to get some form of a trading range on the open. So let's see here. In other words, and what I mean also is even when you get a big gap down in a sell climax, usually it goes sideways. Here, trading range. Rally, big sell off, sideways, sideways for at least 6 bars. Sideways here. If you bought and didn't get out here, you got trapped. A lot of overlap here, overlap here. So the point is, just how many days do you really miss out? Lots of sideways trading here. Trend from the open, you can buy. Situations like this, when I see a big bar like one, I'm generally willing to buy, especially if there's a follow through bar, knowing there's going to be at least a second leg. I'm not expecting a strong bull trend day. I'm expecting a second leg. All right, so that's all the time I have for today. And remember, if you're after the trading room, there will be a Q&A session starting at 4 o'clock Eastern time. So if you want me to answer questions, I can answer them there. Otherwise, for those that are members of the trading room, the end of day review will be in the trading room for tomorrow. All right. Hope everyone has a good rest of their day.